I'm delighted to welcome everyone to Shard Lite-Bite. Today we're going to talk about inflation, and my guest this morning is my colleague, Jacky Ng. Jacky, the headlines this morning, they're all about how the UK is about to experience the worst inflation amongst all the G7 nations, that we're facing a triple whammy of an energy price spike shock, galloping product price rises due to supply chains, and soon we're going to have massive wage demands, which are going to trigger an autumn and winter of industrial strife. It all looks pretty bad. Inflation seems to dominate everything. Can you explain to me why inflation has suddenly got this bad?
Well, it's pretty hard, I think, to pinpoint, a starting point, but it isn't just oil for sure. Inflation was popping up well before the war has started, and oil price moving up to above $100 a barrel. But if we look at the gas market, we've seen the gas prices rising very, very quickly well before the war, and that could be a number of factors contributing to that. There's some commentary saying that it could have been the extreme weather that we saw. We've had a colder winter than usual, and also followed by a warmer summer, which both of them are quite energy intensive. And then, we also see, countries like China trying to decarbonize. So turning away from, generating electricity from coal, instead of that, using natural gas as the electricity generating source. That also put a lot of demand on gas. Other than just the gas, of course, there's a small matter of the pandemic where the disruption caused by lockdowns caused shortage of labor in factories. People couldn't make the production has to be halted for some time, and we also saw supply the shipping industry vastly disrupted because of the pandemic as well. So many factors, I think.
Yeah, and none of these factors seem to be short term. It's going to take an enormous amount of time to build new energy infrastructure to cope with not using Russian gas. It's going to take a long time for supply chains to normalize again, even if they do normalize. But how, and you can't really blame these things on central banks, or can you? How responsible are the central banks for this happening?
It is, again, very difficult to answer. A part of me is a skeptic on how much interest rate has caused all these. Because, if you think of the mechanism of which interest rate affects inflation, it would be higher interest rate causes, people to cost more to borrow, and that in turn, reduce consumption as well as investments. So that is pretty much a demand control mechanism. Whereas a lot of the inflation that we're seeing today are due to a global supply shock, whether it is global pandemic disrupting the supply chain, or whether it is the war causing, lack of oil. People are not buying, that doesn't have the gas and oil to buy anymore.
Okay, now, an awful lot of the inflation that we've been expecting has simply not materialized over the last 12 years since the global financial shock, when in 2008, when central banks stepped in with zero interest rate policies and quantitative easing. And we never really got inflation following all these, what we then called monetary experimentation. Is there an element of that inflation generated in financial assets now coming back to shock the markets as well?
Yes, I'm sure there will be an element of that. I think, what we have seen when we say there is no inflation prior to current market we have seen an inflation of asset prices, as you rightly pointed out. If you look at whether it's bonds, whether it's equity, whether it's property, there is a huge supply of money. Basically, there's money going nowhere. They need to be housed somewhere. And, that caused, the asset prices to go up quite a lot. That especially has occurred in certain sectors. We looked at the information technology sector, where there has been a lot of money flowing into those sectors. And we also look at private market, where, a lot of companies are staying private for longer. Finance is cheaper via debt compared to equity. Equity is, relatively becoming more expensive. So they could borrow more to fund the growth of the company. I think I am also of the opinion that there is, central bank set interest rate, but what it does is it sets a short-term interest rate. The longer-term interest rate is more dependent on the market. So, we see a flat yield curve or a steep yield curve. Long-term interest rate is more dependent on the market rather than direct influence by the central bank. And naturally, that interest rate has been coming down as well. And I think that's down to the demographics of people. So as the baby boomers getting older, they retire, those people are more asset rich. And what is interest rate? It is, it is the time value of money. So what it is how much do you give up on spending today in return for future money? Now, for people who are more asset rich, you will be more willing to give up more money for lower return going forward. So for aging population, where we see in most of the developed economy, then, it is natural that interest rates are going down. That's something that I don't think is entirely due to the Fed's action. And I think it's more of a demographic result. And I keep on saying, obviously, Fed is very, very powerful. All the central banks are. But they don't have the power to influence everything. Short-term interest rate is what they set. It doesn't influence maybe a company going into a 10-year project to build the infrastructure, for example. An overnight interest rate doesn't really give the comfort for people to do that. They need to go into, the market to get that interest, to get that funding. So I tend to not blame the central banks for policy mistakes as much. I think they are just following what the market is telling them.
So what we're discovering, as we have so many times throughout history, is that markets are actually extremely complex. They aren't just a factor of central banks setting interest rates. They're affected by real world events like politics and price shocks, as we're currently seeing, but also real trends. Like, I think we neglect that very important point you just raised about demographics and the influence on consumer behaviors and spending. We'll come back to that, the other thing you mentioned there, which is the vast amount of money that is still slooshing around the financial system waiting for investment. And we'll talk about that in just one second. But before we do, Jacky, give me your views on how long this inflationary period is going to last. In the papers this morning, we're hearing that the Bank of England is preparing for 2 years of way above average interest rates, inflation rates. What's your guess on how long this goes?
Well, one side of the equation, if I look at the UK inflation statistics, the worst components are transport and energy. I think that's probably reaching a peak. I don't think the oil price is going to continue to go up to, I don't know, 150, 200. I don't know what I would predict as an oil price, but I think we are nearer to the peak of oil price than to. So I don't see, oil price or energy prices continue to be a factor in leading this inflation. Now, what is important, as you touched on previously, is how does the current inflation environment translate into other elements of inflation? One thing that's very, very important would be wage inflation. If everyone says, it costs me double the money to fill up my car, my company, I need to get more money for it. And if my company isn't giving me that, I will look for a new job. And if the labor market is tight, people wants to hire, they will have to pay more money for that. And that is the second derivative of inflation. That's what causes the kind of a much longer term inflationary period, as opposed to just the current, energy shock. Now, the question for me is, I don't really know whether this is gonna turn into that. I think there is a good chance, coupled with, there is also on the agriculture side, we're also facing food inflation as well. So for general public, it is very, very hard right now to compare to just 2 years ago, just to sustain your living. So it is possible, and I've probably put a higher chance of wage inflation to start to pick up than I wouldn't. But one thing for us as wealth manager is, I think market is really priced into this, the high inflationary environment. We can look at the break-even rate between the linkers versus the gilts. It is pricing at circa 4.8% or something like that, and that's pricing in a bit of inflation. So inflation isn't a surprise anymore, as opposed to at the start of the year where fewer people were predicting there will be an inflationary problem.
Okay, so inflation's not a surprise anymore. We're into these second and third derivative effects caused by inflation, which are likely to last longer. We know that inflation's here. We're not surprised by it anymore. What should investors be doing and investing in an inflationary period like this, which may even turn into a stagflationary period?
I think it's important to recognize that in an inflationary period, financial assets normally suffers. Whether you're looking at bonds, whether you're looking at equity, bonds is a direct relations. Interest rate has to go up, bond prices goes down. It's as simple as that. And equity, there's slightly more kind of a secondary effect where companies will find it more difficult to raise capital, as well as the source of revenue would be, or they will have to raise prices, and that would then depend on the elasticity of the goods and services. If they are sticky, then they would be able to pass on that inflation to the consumers, wouldn't suffer as much. But there will be a lot of companies who will be suffering from the consumers downside, not downsizing, but downgrading the brands. Choosing whether to go from a luxury or Marks and Spencer going down to Lidl or Aldi. That will eat into their margin. So for equity, it's not great either. So areas where you will probably be better off is probably precious metals. Gold is an interesting hedge, I think, for now, for both inflationary problem and also potential recession going forward. It is something that I think a generous portion of gold in the portfolio would be a good idea in the current environment.
Okay. What about corporate bonds? That's the market I'm most concerned about at the moment. because I think we're going to head into at least a recession, if not full stagnation. We're going to see an awful lot of companies struggling with higher interest rates and especially higher bond rates to refinance the borrowing that they undertook over the last 5 years. And the market is extremely illiquid. It's very difficult for investors to get out of their credit positions, their corporate bond positions. Are there any sectors like corporate bonds that you're particularly fearful around?
I think corporate bonds is general. If I look at the credit spread of the market, is not very high. And I think in terms of the market, bond markets are always a lot quicker than equity markets. So I think the spread is a good indication of whether we are in troubles ahead. At the moment, it's still behaving quite benign. It's not too bad. There are certain sectors, for example, if you look at the Chinese property sectors, where the whole sector was suffering from over leveraging, borrowing so much money to build so much inventory that no one wants to buy now. They are in deep trouble. But generally speaking, I think the amount of debts that corporate has is under control. But we are starting to see some reports. I think it's one of the hot topics within our company is the, buy now, save, pay later sort of model. I think consumer debt is, inching higher, and that's going to get worse because cost of living is getting higher. And if you already spent the money to buy whatever goods that you have, you need to find more money.
Okay, so we've got consumer sector being a potential problem. Are there any other sectors of the market that you think may be particular value in this environment?
I think if I'm investing money, particularly in equity, I will look very carefully about their balance sheets. I'll look at companies that are healthier, in a healthier state. I would avoid companies that are not really generating that much profit right now, because funding for them is going to be very expensive and going to be more difficult going forward. Companies that are generating cash flow right now should be relatively better placed compared to those growth companies. We should also be looking at how stable the cash flow is for those companies, the revenue. If we are looking at, I think the current tech sell-off has opened up some opportunities for their companies. Some more mature tech companies have had a huge sell-off too, but a lot of them have moved their customers onto a subscription-based model. So their revenue is very, very sticky. The product is very important. If you think about how integrated a software would be for corporates, if they've implemented a software, it is not an easy decision just to say switch and stop it. You just have to get on with it and fund your other savings elsewhere. So I believe there are some interesting opportunities out there where the valuation is much more compelling compared to before, and they should be a bit more sticky. We look at older sectors such as tobacco, for example, is the ultimate price inelastic goods. People are addicted to nicotine, and the volume is generally going down, but it's very predictable how much they go down, and it's quite easy to model. They are generating a lot of cash flow, and the sector is very consolidated. There are only a handful of players, 4 players out there, so they are very disciplined in terms of pricing, market share. They're not aggressive. All they do is just buy each other, consolidate, and and generate more profit. So that's an interesting sector. And the other bit that has the other bit of the market that's also under a bit of consolidation is the basic material sector. I think that's more cyclical for obvious reason. But even when we had China lockdown for a while, a few weeks, we're still seeing those companies performing quite well. There has been somewhat decoupling from basic material sector from a pure China story. They are now, quite frankly, a cash machine. They generate a lot of profit. They are the sector is dominated by quite a few big players, and they don't prioritize getting market shares. As they're now more prioritizing generating profit. They pay a good yield, and they're trading on cheap valuation. So it's something that I think is reasonable to hold on to. And in an inflationary environment, commodities go up as well, so they will benefit from that.
Excellent, great. Well, look, Jacky, thank you very much for these thoughts. I mean, clearly we're into a very different and potentially difficult market as inflation looks to be around for some time. But it sounds like there are plenty of opportunities and plenty of ways that we can invest into this market. So thanks very much for the time. And hopefully in a few weeks' time, we'll be talking about something more positive.
Great. Thank you for your time, Bill.